I'm Ray Dalio. I managed over $124 billion. I predicted the 2008 financial crisis 18 months before it happened. I called the dot-com crash. I navigated every major economic cycle for the last 50 years. And I'm about to tell you something that's going to make a lot of financial advisors very angry with me. Now, in part one of this series, I showed you exactly how I build wealth from absolute zero, month by month, $0 to $20,000 in 12 knots, the exact foundation. Emergency fund skills, income streams. The system that works whether you're 25 or 55. But here's what I didn't tell you in part one. If you're already over 40 years old with savings, with a 401k, with a portfolio you spent decades building, everything changes because you don't have time to start from zero if this goes wrong. You can't afford to lose 10 or 20 years rebuilding. The math doesn't work. So this is part two. This is for everyone who's already built something and needs to protect it. Because what I'm about to show you is how to make sure you don't lose everything you've worked for in the next 12 to 24 months. If you're over 40 years old right now and you're following conventional financial advice, you're going to lose most of your savings in the next 12 to 24 months. Not some of it, most of it. And the people giving you that advice, your financial advisor, your 401k manager, CNBC, whoever, they're either lying to you or they don't understand what's coming. I'm not being dramatic. I'm reading the machine, the economic machine, the same machine I've studied for 50 years, the same machine that told me 2008 was coming, the same machine that's screaming at me right now that we're in the late stages of a long-term debt cycle. And if you don't understand what that means, you're about to find out the expensive way. Here's what nobody's telling you. We're not in a normal market cycle. This isn't 2015 or 2019 where you could just buy index funds and wait it out. We're in year 75 of a 75 to 100 year debt super cycle. And when these cycles end, they don't end quietly. They end with defaults, restructuring, currency devaluation, and wealth transfer on a scale most people alive today have never seen. The last time this happened was the 1930s and 40s. Before that, the 1860s. Before that, the 1780s. It happens roughly every 75 to 100 years. And it's happening right now. The only question is whether you're positioned to survive it or whether you're going to be one of the casualties. So if you're over 40, listen very carefully. You don't have time to recover from this. If you're 45 and you lose 60% of your savings in the next 2 years, you will not make it back before retirement. The math doesn't work. Compounding doesn't have enough time. You will work until you're 75, or you will depend on your children, or you will live in poverty. Those are your options if you get this wrong. But here's the thing. This is predictable. I've seen this pattern play out in dozens of countries over the last century. I know exactly what happens next. I know who gets destroyed and who builds generational wealth. And I'm going to tell you exactly what to do. But you have to understand the machine first, because if you don't understand why this is happening, you'll panic at the wrong time. You'll sell at the bottom and you'll lock in permanent losses. So pay attention. What I'm about to explain might be the most important financial education you ever get. Let me explain what's happening right now in terms so simple that anyone can understand it. Debt cycles work like this. For 75 years, we've been accumulating debt, government debt, corporate debt, consumer debt, all of it. And for 75 years, interest rates have been falling, from 15% in 1981 to basically 0% in 2020. Falling interest rates make old debt easier to service. You borrow $100 at 10%, then refinance it at 5%, then at 2%. Your debt load goes up, but your payments stay manageable. Everyone feels rich, but here's the problem. You can only cut interest rates to zero once. After that, the machine breaks. You can't refinance debt at negative 5%. It doesn't work. So what do central banks do? They print money. They call it quantitative easing or stimulus or whatever sounds less terrifying, but it's money printing, creating currency out of thin air. And what does that do? It devalues the currency. The dollars in your bank account, the dollars in your 401k, the dollars you've been saving for 30 years, they buy less, a lot less. That's inflation, not the 2% to 3% your government tells you real inflation, the kind that destroys purchasing power. So now we're stuck. We have record debt that can't be paid back. We have interest rates that can't go lower. And we have central banks printing money to keep the system from collapsing. This is the end stage of the long-term debt cycle. And it ends one of three ways. Option one, defaults. Governments, corporations, individuals stop paying their debts. Bankruptcy, recession, depression, massive wealth destruction. Option two, restructuring. Debts get renegotiated. You owed $100. Now you owe $50 paid out over 20 years at low interest. Sounds nice until you realize if you're the one who lent that $100, you just lost half your money. Option three, inflation. Print enough money and the debt becomes worthless. You owed $100,000 in 2020. By 2030, that same $100,000 is pocket change because the currency collapsed. Great if you're a debtor. Catastrophic if you're a saver. Now here's what kills me. Most people over 40, their entire financial strategy is designed for a world that no longer exists. They've been told for 30 years, save in dollars, buy index funds, hold bonds, max out your 401k, retire at 65. That advice worked brilliantly from 1980 to 2020. Falling interest rates, rising markets, stable currency. It was a golden age. But that world is over. The machine changed. And the advice that made people rich over the last 40 years will make people poor over the next 10. I'm not guessing. I'm not predicting. I'm reading the machine. But before I reveal the asset class that thrives in this environment, I need to warn you about something. There's a trap that even sophisticated investors fall into. A mistake that looks like smart diversification but is actually catastrophic concentration. I watched this destroy portfolios worth $50 million, $100 million in 2008. People thought they were protected. They weren't. I'll show you exactly what this trap is and how to avoid it in about 4 minutes. First, let me explain why your current strategy is even more broken than you think. But here's what nobody tells you about debt cycles. There's one asset class that not only survives, but thrives during the end stage. I learned this studying the 1930s, the 1970s, and every deleveraging in history. Most investors don't know this. Their advisors don't tell them. And the ones who figure it out early make fortunes. I'll reveal exactly what it is in 8 minutes. But first, you need to understand why your current strategy is broken. Let me show you why the conventional advice you're following is going to destroy you. Conventional advice says, put 60% in stocks, 40% in bonds. Rebalance annually. Hold for the long term. It's called the 60-40 portfolio. Every financial advisor recommends it. It's been the standard for 40 years. Here's the problem. That strategy was built for a falling interest rate environment. When rates fall, bond prices go up. When rates fall, stock multiples expand. You win on both sides. Beautiful. But we're not in a falling rate environment anymore. Rates are going up, or they're stuck at zero while inflation runs hot. Either way, bonds are getting destroyed. A 10-year Treasury bond loses 10 to 15% of its value for every 1% rise in interest rates. If rates go from 4 to 6%, that's a 20% to 30% loss on your safe bonds. And stocks? Stocks are priced for perfection. S&P 500 trading at 25 times earnings. That's 50% above the historical average. In a normal reversion to the mean, the market drops 30% just to get back to average. And if we get a real deleveraging, 50 to 60% drawdowns. Happened in the 1930s, happened in 2008. It'll happen again. So your 60 to 40 portfolio, Both sides are broken. Bonds lose because rates are rising or inflation is destroying real returns. Stocks lose because valuations are insane and earnings collapse when the debt cycle unwinds. You're about to get hit from both directions simultaneously. But Ray, what about diversification? What about holding international stocks? What about gold? Good questions. Let me address them because this is where most people get confused. International stocks, you're just exporting the same problem. Europe, Japan, China, they're all in the same debt supercycle. Some are further along, some are behind, but they're all trapped. Diversifying across countries that are all drowning doesn't save you. Gold, better. Gold has historically preserved purchasing power during currency debasement, but it doesn't pay income, it doesn't compound, and it's volatile. If you bought gold in 1980 at $800 as he awaited 28 years just to break even, that's a long time when you're over 40. Real estate, maybe. If you own it outright, if it generates cash flow, if you're in the right market. But if you bought at the top with a mortgage and the economy tanks and you can't cover the payment, you're bankrupt. Real estate is great leverage in the right environment. It's a wealth destroyer in the wrong one. Here's what I learned studying every major deleveraging in history. In the 1930s, in the 1970s, in Japan, in the 1990s, in 2008, there's one pattern that repeats every single time. The people who survive, the people who build wealth, they're not diversified across broken assets. They're concentrated in the one thing that works. And that one thing has three characteristics. One, it preserves purchasing power when currency is being debased. Two, it generates cash flow you can live on. Three, it's relatively uncorrelated to stocks and bonds, so when those collapse, it holds steady or goes up. Most people never figure out what this is. They spend the crisis panicking, selling at the bottom, locking in losses. But the people who understand the machine, they know exactly what to own. And they position themselves 12 to 24 months before the crisis hits. We're in that window right now. 12 to 24 months before the real pain starts. I'll tell you exactly what to buy in the next section, but first, let me tell you a story about what happens when you don't listen. In 2006, I sat down with a very successful executive. Let's call him David. David was 52 years old. He had $2.3 million saved. He was on track to retire at 62 with $4 million based on his projections. He felt great. He was following all the conventional advice, diversified portfolio, 60% stocks, 40% bonds, working with a big name wealth management firm. I told him the same thing I'm telling you now. We're late in the debt cycle. Housing is over-leveraged. Banks are holding toxic assets. A crisis is coming. You need to reposition. He didn't listen. His advisor told him I was being alarmist. Ray's a hedge fund guy, they said. He makes money betting against the market. Of course, he's predicting doom. The fundamentals are strong. Stay the course. So David stayed the course. 2007 came. Market kept going up. David felt vindicated. See, Ray was wrong. I'm up another 12% this year. Then 2008 hit. His portfolio dropped 52%. That $2.3 million became $1.1 million. He was 54 years old. He needed that money to start compounding again, but the market didn't fully recover until 2013. He was 59. He didn't have enough time left. He pushed retirement to 68, then to 70. Last I heard, he's 70 years old and still working because his nest egg never recovered. Here's what kills me about that story. It was completely preventable. The data was there. The machine was screaming. But he listened to the wrong people. He followed conventional advice, and it cost him 8 years of his life. Don't be David. But here's the good news. You're not David. You're watching this video right now, which means you're paying attention. David ignored the warnings in 2006. You're listening to them in 2006 before the crisis hits. We're in stage 7 of an 8-stage deleveraging. That means you still have time. You have 12 to 24 months to reposition. That's the window. David didn't have that. He waited until stage 8 when everything was collapsing. You're early. That's your advantage, so don't be David. But also understand you're already ahead of 95% of people just by being here, paying attention, willing to question conventional wisdom. Now, you just need to act on what I'm about to show you. Now, you might be thinking, but Ray, 2008 was different. We learned from that. The system is safer now. Banks are better capitalized. Regulations are tighter. Wrong, dead wrong. The system is more fragile now than it was in 2008. Total debt is higher. Asset prices are more inflated. Central banks have less ammunition. When this breaks, and it will break, it's going to make 2008 look like a warm-up. But here's the good news. If you understand this is coming, you can position yourself to not just survive, but profit. There are people who made fortunes in 2008, not by luck, by understanding the machine and positioning correctly 18 months before it hit. I'm going to show you exactly how to do that. But first, I need you to understand one more thing about timing, because a lot of people understand the problem, but they get the timing wrong. They panic too early or they wait too long. And timing is everything. And here's something critical I learned in 2008 that I'm going to share with you at the 22-minute mark. There's a specific sequence to repositioning, a specific order you have to sell and buy assets in. Get the order wrong, and you lose 30% to 40% immediately, even if you're buying the right things. I watched investors in 2008 buy gold first, then sell stocks. They thought they were being smart, but because they got the sequence backwards, they locked in a 35% loss on their stock sale and paid 20% more for gold than they needed to. Same assets, wrong order, massive wealth destruction. I'll give you the exact sequence in about 6 minutes, but first you need to understand where we are in the crisis timeline so you know when to act. Here's what most people get wrong about crisis timing. They think it's binary. They think either the crisis happens or it doesn't. But that's not how the machine works. The machine moves in stages. Right now, we're in stage 7 of an 8-stage deleveraging. Let me walk you through them so you know where we are. Stage 1, the boom. Credit is cheap. Everyone's borrowing. Asset prices are rising. Everyone feels rich. That was 2010 to 2020. Stage 2, the bubble. Prices detach from fundamentals. Valuations make no sense, but nobody cares because everything's going up. That was 2020 to 2021. Stage 3, the top. The last suckers pile in. Retail investors are euphoric. Professionals are quietly selling. That was late 2021. Stage 4, the initial decline. Market drops 10%, 15%, 20%. Everyone says it's just a correction. Buy the dip. That was 2022. Stage 5, the bear market rally. Market recovers 20%, 30%. Everyone thinks the bottom is in. Crisis averted. That was 2023. Stage 6, the rolling crisis. Small cracks appear. A regional bank fails. A country defaults. A major company goes bankrupt. But it's contained, no contagion yet. That's 2024 and early 2025. Stage 7, the awakening. People start to realize the problem is systemic, not isolated. Fear spreads. Selling accelerates. That's where we are right now, late 2025 into 2026. Stage 8, the crisis. Everything breaks at once. Markets crash. Credit freezes. Wealth evaporates. That's 2026 into 2027, maybe 2028. Most people wait until stage 8 to act. By then, it's too late. Asset prices have already crashed. You're selling at the bottom. You're walking in permanent losses. The smart money acts in stage 6 or early stage 7. That's right now. They're repositioning before the panic. They're moving from broken assets into the assets that work during a crisis. They're building their ark while everyone else is still partying on the Titanic. So here's the question you need to ask yourself. Are you going to wait until everyone's panicking and act out of fear? Or are you going to act now, systematically, based on principles? Because here's what I've learned in 50 years of doing this. The people who panic make terrible decisions. They sell at the bottom. They buy garbage. They get scammed. They lose everything. But the people who act early, based on understanding the machine, not on emotion, they make fortunes. Not because they're smarter, because they have a system. Now, I promised I'd tell you exactly what to buy, what asset class survives and thrives during a debt cycle crisis. But before I do, I need to tell you about the biggest mistake I see people over 40 make when they try to reposition. It's subtle. Most people don't even realize they're making it, and it costs them 40% to 60% of their wealth even when they think they're being smart. I made this mistake myself in 1984. It cost me $6 million to learn. I'll show you exactly what it is in the next section. Let me tell you about 1984. I'd rebuilt my firm after the 1982 disaster. I understood debt cycles. I knew a recession was coming. I positioned the portfolio defensively, sold stocks, bought treasury bonds, held cash. I thought I was being smart. The recession came. I was right. Stocks dropped 15%. But here's what I didn't see coming. The Federal Reserve cut interest rates aggressively. They printed money. They bailed out banks. And instead of a prolonged downturn, the market V-shaped recovered in 6 months. My treasury bonds made 8%. Great. But stocks bounced 35%. The clients who ignored my advice and stayed in stocks made 20% more than me. I was right about the crisis, but wrong about the policy response. And that wrongness cost me $6 million in fees I didn't earn because my performance lagged. Here's the lesson. It's not enough to know a crisis is coming. You have to know how policymakers will respond, because their response determines which assets win and which assets lose. In 1984, they chose inflation over deflation. They printed money. That made stocks recover fast, but destroyed the real value of bonds and cash. In 2008, they did the same thing. Trillions in stimulus. Stocks recovered, but the dollar lost purchasing power. In 2020, same pattern. Print money, inflate assets, destroy savers. So here's what's going to happen in 2026 and 2027. When the crisis hits, and it will hit, central banks will print money again. Except this time it won't work because they've already printed too much, because debt is too high, because trust in the currency is too low. So you're going to see inflation and deflation at the same time. Certain assets will collapse. Certain assets will explode. And if you're positioned in the wrong ones, you're finished. Here's what people over 40 get wrong. They think safety means cash and bonds. It doesn't, not in an inflationary deleveraging. Cash loses purchasing power. Bonds default or get inflated away. You're safe from volatility, but you're guaranteed to get poor slowly. What you actually need is assets that hold value when currency is being destroyed. Assets that generate real income, not nominal income. Assets that benefit from the chaos instead of getting crushed by it. There are exactly 3 asset classes that fit this criteria. I own all 3. I've been accumulating all 3 for the last 18 months, and I'm going to tell you what they are right now. But here's the thing. Most financial advisors won't tell you about these. Why? Because they don't make commissions on them, because they're not part of the traditional portfolio, because they require you to think differently. So if you're working with an advisor right now and they haven't mentioned these 3 asset classes, fire them today, because they're either incompetent or they're putting their commissions above you financial survival. All right, let's get into it. Asset class number 1. Inflation-protected cash-flowing businesses, not stocks, not index funds, individual businesses that have 3 characteristics. 1, they can raise prices faster than inflation. 2, they generate cash flow you can live on. 3, they have hard assets or intellectual property that holds value. Examples: certain energy companies, certain agriculture businesses, certain infrastructure. These companies own real assets, pipelines, farmland, toll roads that can't be printed, and they generate revenue that adjusts with inflation. In the 1970s, when inflation ran at 10 to 15%, most stocks got destroyed. But the oil companies, they exploded. Why? Because when oil goes from $10 to $80 a barrel, energy companies print money, their costs go up 20%, their revenues go up 200%. Massive cash flow. Same with agriculture. When food prices double, farmers who own land make fortunes. When infrastructure is needed, the companies that own the bridges and toll roads get paid. So if you're over 40, here's what you do. Take 30% to 40 portfolio. Find 5 to 8 businesses that own hard assets and generate cash flow. Buy them, hold them, collect the dividends. When inflation hits, these will be the only stocks that don't collapse. Asset class number 2, real assets you can touch. I'm talking about physical gold, physical silver, commodities, farmland if you can afford it. These are not speculative plays. These are wealth preservation plays. Gold has held value for 5,000 years. Every time a currency collapses, gold survives. It's the ultimate insurance policy against monetary stupidity. But here's the key. Physical gold, not gold ETFs, not gold stocks, not gold futures. Physical metal that you own and control. Because when the crisis hits, you want the asset, not a promise to deliver the asset. I own physical gold. I keep it in a vault. It's 10% of my liquid net worth. I hope I never have to use it. But if the dollar loses 50% of its value over the next 10 years, that gold doubles in dollar terms. It's not an investment, it's insurance. Asset class number 3, your own skills and relationships. This sounds soft, it's not. In a crisis, the most valuable asset is your ability to generate income independent of the financial system. If you're 45 years old and your only income source is a 401k that just dropped 60%, you're finished. But if you're 45 years old and you have a skill that people pay for, you can code, you can sell, you can build, you can consult, you can earn your way through the crisis. This is why I tell everyone over 40, invest in skills, learn something that makes you valuable, build relationships with people who can hire you, partner with you, refer you. Because when the machine breaks, the people who survive are the ones who can create value independent of the broken system. So those are the 3 asset classes: inflation-protected businesses, real assets, skills, and relationships. If you own all 3, you survive. If you don't, you're gambling that the system holds together, and it won't. Now, I know this sounds complex. Economic machine, debt cycles, inflation-protected businesses. You might be thinking, Ray, this is too complicated. I'm not a hedge fund manager. I can't do this. But here's the truth. This is actually simpler than what you're doing right now. Your current strategy requires you to predict which stocks are going to go up, which bonds are safe, when to buy, when to sell. That's impossible. Nobody can do that consistently. Not me, not Warren Buffett, nobody. This strategy doesn't require prediction. It requires understanding one thing, the machine. And I just explained the machine to you in 15 minutes. Once you understand the machine, the decisions become obvious. You're not predicting, you're responding to the mechanics. So this is actually easier. It's just different from what you've been taught. And different feels harder at first, but it's not. It's simpler, more systematic, and it actually works during the crisis. Now, here's where most people fail, even when they understand this. They know what to buy, but they don't know how much. They don't know what. They don't know the order. And so they either go all in too early, or they hesitate too long, or they do it wrong. There's a specific sequence, a specific allocation, a specific timeline. Get this wrong and you still lose. I'll show you the exact sequence in the next section. All right, you understand the problem. You understand what to own. Now let me give you the exact sequence for repositioning your portfolio if you're over 40. Step 1, calculate your runway. How many years until you need this money? If you're 45 and planning to retire at 65, you have 20 years. If you're 58 and planning to retire at 63, you have 5 years. This number determines your aggressiveness. If you have 20 years, you can be aggressive. You can ride out volatility. You can reposition over 6 to 12 months. If you have 5 years, you need to be fast. You don't have time to wait for the perfect entry. You reposition over 60 to 90 days. Step 2, sell the broken assets, not all at once, but systematically. Over 3 to 6 months, if you're holding long-term bonds, sell them. They're going to get destroyed by rising rates or inflation. Take the tax hit, move on. If you're holding overvalued growth stocks trading at 50, 60, 100 times earnings, sell them. They're going to crash 70% to 80% when the deleveraging hits. If you're holding anything that doesn't generate cash flow and relies on greater fool theory, meme stocks, speculative crypto, whatever, sell it. Now, step 3, build your positions in the 3 asset classes. Start with 10 to 15% in physical gold and silver. This is your insurance. Buy it first. Store it securely. Then 30% to 40% in inflation-protected cash-flowing businesses. Do your research. Find companies that own hard assets. Buy 5 to 8 of them. Diversify, but don't over-diversify. Then 20% to 30% in short-term treasury bills or high-yield savings earning 4% to 5%. This is your dry powder. When the crisis hits and assets crash, you want cash to deploy. The remaining 15 to 25%, invest in yourself. Skills, relationships, education. This is the piece most people ignore. Don't. Step 4, rebalance quarterly. As the crisis unfolds, some assets will outperform. Some will underperform. Don't panic. Don't deviate. Rebalance every 90 days to maintain your allocation. This is a system. This is an algorithm. You follow it regardless of what the market does, regardless of what the news says, regardless of how you feel. Because your feelings are designed to destroy you in a crisis. Now, I know what you're thinking. Ray, what if you're wrong? What if the crisis doesn't come? What if I reposition and then the market just keeps going up? Fair question. Let me answer it. If I'm wrong and the system holds together and we don't get a deleveraging, here's what happens to you. Your inflation-protected businesses still generate cash flow. Your physical gold just sits there, costing you 1% a year in storage. Your skills make you more valuable. Your dry powder earns 4% to 5%. You don't get rich. But you don't go broke either. You compound slowly, and in 10 years, you're fine. But if I'm right and the crisis comes, here's what happens. Your old portfolio would have dropped 50% to 60%. Your new portfolio drops 10 to 20%, maybe goes up. You preserve capital. You collect income. And when assets crash, you deploy your dry powder and buy generational wealth at 50 cents on the dollar. That's the asymmetry. If I'm wrong, you're okay. If I'm right, you're rich. That's a bet worth taking when you're over 40 and you don't have time to recover from a catastrophic loss. Before I close, let me give you one final piece of guidance. If you do nothing else from this video, if you only take one single action this week, do this. There's one move that preserved more wealth in the 1930s and in 2008 than anything else. It's not sexy. It's not exciting. But it's the difference between people who lost 60% and people who lost 10%. I can't share it here because YouTube's algorithm would bury this video, but it's in part 3, minute 3. Watch part 3 just for that one insight. Even if you ignore everything else, that one move could save your retirement. Let me be very clear about something. Most of you watching this won't do what I just told you to do. You'll watch this video, you'll nod along, you'll say, yeah, Ray makes sense, I should probably reposition. And then you'll do nothing. You'll talk yourself out of it. Maybe he's being too pessimistic. Maybe the system holds together. Maybe I should wait and see. Maybe I should ask my financial advisor first. And your financial advisor will tell you to stay the course. Because they make money when you stay invested in their funds. They make nothing when you buy physical gold or invest in skills. So they'll give you every reason to ignore what I just said, and you'll listen to them because it's easier. because change is hard, because admitting you've been following the wrong strategy for 20 years is painful. But here's what's going to happen. In 12 to 24 months, the crisis I'm describing will be obvious to everyone. The market will have crashed. Your portfolio will be down 40%, 50%, 60%, and then you'll remember this video and you'll think, I should have listened. But by then, it's too late. The damage is done. You can't undo a 50% loss when you're 55 years old. The math doesn't work. You'll spend the rest of your life working or depending on others or living with regret. Don't be that person. I've seen this pattern play out in every crisis I've studied. The 1930s, the 1970s, 2008, 2020, there were always two groups. The people who saw it coming and repositioned, and the people who ignored the warnings and got destroyed. The people who repositioned made fortunes, not because they were smarter, because they had a system, because they understood the machine, because they acted on principles instead of emotions. The people who ignored the warnings lost decades of wealth. They spent the rest of their lives bitter, angry, blaming everyone but themselves. Which group do you want to be in? I'm 75 years old. I've been doing this for 50 years old. I've been doing this for 50 years. I've managed $124 billion. I've navigated every crisis. I've studied every deleveraging. I know what's coming. And I'm telling you as clearly as I can, reposition now. Not next month. Not after you talk to your advisor. Not after you see how the market performs in Q1. Now, today, this week, because the window is closing. We're in stage 7 of 8. In 6 months, we'll be in stage 8, and by then, it's too late. The people who act now will be the people who survive. The people who hesitate will be the casualties. It's that simple. It's that brutal. It's math. So here's my last piece of advice. Turn off this video. Sit down with your portfolio, calculate how much you have in broken assets, overvalued stocks, long-term bonds, speculative garbage, and start selling this week. Over the next 30 to 60 days, reposition into the 3 asset classes I described. Build the system, follow the algorithm, and in 12 months, when everyone else is panicking, you'll be the calm one because you'll have a system. You'll be positioned correctly. You'll survive or don't. Ignore me. Stay the course. Follow conventional advice. And in 12 months, don't say I didn't warn you. If you made it this far, you're in the top 5% of people watching this video. Most people clicked away after 3 minutes looking for easier answers. Good. Less competition for you, but we're not done. This is just the foundation. I showed you what to own. I showed you the repositioning sequence, but I didn't show you the specific companies, the specific allocations, the specific timing for each move. So in this video, part 2, I showed you 3 things. The 3 asset classes that actually survive a debt crisis, the exact sequence for repositioning your portfolio if you're over 40, and the one mindset shift you need to stop thinking like a victim of the system and start thinking like an architect of your own wealth. In part 3, I'm going to show you something even more critical. The exact 7 inflation-protected businesses I own right now and why. How much physical gold and silver to buy based on your age and net worth. The 3 highest paying skills to learn in 2026 that make you recession-proof. The one mistake people make when buying real assets that cost them 30% immediately. And my complete allocation spreadsheet for ages 50 and 60. This isn't theory. This is my actual portfolio, my actual system. The same principles I use to manage $124 billion. Part 3 drops in 3 days. Hit subscribe so you don't miss it, because the crisis isn't waiting for you to be ready. It's coming, whether you're prepared or not. And if you want my complete crisis survival guide, every principle, every allocation, every timeline, check the playlist below. It's everything I learned in 50 years of studying deleveragings, all in one place. The choice is yours. Act now based on principles, or panic later based on fear. I know which one works. I've seen it work for 50 years. Now go execute.